The standard American retirement playbook is drilled into us from the day we start working. Grab your employer's 401k match, max out your Roth IRA, and put your head down. And because we are so hyper-focused on those two accounts, we tend to flip right past the boring health benefits binder during open enrollment. But if you look at these standard tax buckets, you'll see the flaw in that playbook. A traditional 401k gives you a tax deduction on the way in, but taxes you on the way out. A Roth IRA ignores you on the way in, but gives you a tax-free exit. But there is a distinct third bucket here in the middle, an account with a triple tax advantage. The money goes in tax-free, grows tax-free, and comes out tax-free, and it is sitting in the health insurance section of the tax code. It is the Health Savings Account, or HSA. The government created this account in 2003 simply as a behavioral carrot. The goal was to push workers into high-deductible health plans, and the tax breaks were the incentive to get them there. Nobody in Washington designed this to be a retirement vehicle. Because of that medical packaging, millions of workers assume the HSA is just a glorified debit card for doctor visits. They put a few $100s in and then immediately drain it to pay for urgent care or a prescription. By constantly zeroing out the balance, they completely evaporate the mathematical power of the account. Most workers treat the HSA as a temporary holding pen for immediate medical bills. By using the account this way, they bypass the specific mechanics required to turn these tax breaks into a significant long-term asset. To legally open an HSA, you must be enrolled in a high-deductible health plan, or HDHP. In exchange for paying a lower monthly premium, you agree to take on a higher baseline out-of-pocket cost before your insurance actually kicks in. That higher deductible is your barrier to entry. Enrolling in rid of these plans grants access to tax break number 1, the deduction on the money going in. HSA contributions are entirely deductible from your federal income tax. But if you contribute through a payroll deduction at work, the HSA does something a traditional 401k cannot do. It legally bypasses the 15.3% FICA payroll tax. Tax break number 2 is the growth. Once your balance clears a small minimum threshold, usually $1,000 or $2,000, you can move those funds out of cash and invest them in broad market index funds. Every dividend and capital gain compounds completely tax-free. This growth curve illustrates how invested HSA funds rapidly outpace basic cash savings. But if you don't actively invest, your money sits in stagnant cash, and the entire tax shelter advantage dies. Tax break number 3 is the exit. When you pull that invested money out to pay for a qualified medical expense, you owe 0 federal income tax. Not deferred, 0. No other legal account in the United States tax code successfully dodges the IRS at all 3 stages of the wealth-building life cycle. Those 3 tax breaks are excellent, but they still restrict you to medical spending. What turns the HSA into a lifelong retirement strategy are 2 specific IRS loopholes. Loophole number 1, there is absolutely no legal deadline requiring you to reimburse yourself for a medical expense. This creates what financial planners call the shoebox method. If you incur a $200 medical bill, you pay it with a regular credit card. This allows the balance to continue compounding in the market while you permanently save the receipt. 30 years pass. Your HSA balance has grown massively. You decide you want $200 to go on vacation. You simply pull up that decades-old receipt, submit it as a qualified medical expense, and pull the newly compounded cash out tax-free. The IRS doesn't care that the original expense has ancient history. Loophole number 2 triggers on your 65th birthday. At age 65, the HSA legally drops its strict 20% penalty for non-medical withdrawals. It simply stops being exclusively a healthcare account. If you pull money out for non-medical reasons after 65, say to buy a boat or remodel a kitchen, you just pay ordinary income tax on the withdrawal. In the absolute worst-case scenario, the HSA behaves exactly like a traditional 401k. The combination of the shoebox method and the age 65 rule eliminates the typical wall surrounding a healthcare account. These rules provide the same withdrawal flexibility you would expect from a long-term retirement fund. Even without those 2 loopholes, the HSA's core design perfectly intercepts the hardest mathematical realities of getting older. According to baseline estimates from Fidelity, healthcare will easily be one of your top 5 expenses in retirement. A single 65-year-old retiring today is projected to spend roughly $172,000 on baseline healthcare. For a couple, it's double, and basic Medicare premiums alone will eat up nearly $76,000 of that total. This side-by-side chart shows exactly how that math plays out when you have to pay those inevitable bills. If you pull $100,000 out of a traditional 401k, a 22% tax rate shrinks it to $78,000. But pulling that exact same amount from an invested HSA retains the full $100,000. Because massive healthcare spending in your later years is mathematically guaranteed, an HSA successfully crushes standard retirement accounts by a full marginal tax bracket. To actually execute this strategy, step 1 is running the numbers on your own cash flow. If you have young kids or a condition requiring heavy prescriptions, a high-deductible health plan might cost you more out of pocket than the tax breaks save you. Calculate the risk before you commit. If the math works in your favor, your investment hierarchy needs an immediate update. Step 1 remains unchanged. Grab your employer's 401k match. That is guaranteed free money, and nothing beats it. But step 2 is the pivot. Immediately after securing that match, you route your dollars to max out your HSA and invest the balance. You do this before you put a single dime into a Roth IRA. If you want more calm, math-grounded breakdowns of backdoor strategies and hidden tax code rules, hit the subscribe button. We read your comments, and they directly shape the topics we run the numbers on next. The United States tax code contains a powerful retirement vehicle within the health insurance section. It is time to